Coming up today, a rotation out of big tech on the back of Alphabet and AMD earnings. Will China go after Apple? Stocks that could perform well going into Super Bowl? Why I think Uber's good value? Central banks gobbling up gold? And why we could be on the cusp of a monster rotation in the market. Stay tuned for this one, guys. Let's go. And so we saw a pretty swift rotation in the market today out of mega cap tech. Apart from NVDA, the rest of them were quite soft and weak. Alphabet actually down almost 7% on the back of their earnings, along with Uber, AMD, both of which I think are at good value at the moment, along with another stock I'll get into later today, so stick with me. But first, let's just talk a little bit about this rotation, as mega cap tech has been the winning group over the last couple of years. We saw a really good bullish breadth of a day across the board here, with once again the Russell 2000 small caps, the leading indice. S&P 500 didn't finish up quite 0.5%, but the Russell pushing up against monthly highs again, up over 1% here, and just drawing a volume profile from the day after the election to where we are right now. We can see the price just sitting slightly above the point of control, POC, kind of like the most traded area on a volume weighted basis. And if we get another good push tomorrow or going into the weekend on Friday, that can typically sway the market from kind of this bearish stance it's been in over the last month, and maybe really open up small caps here, as the new Trump admin is bullish for small caps, already enacting dozens of American first policies, really wants to bring manufacturing and production back to America. That's good for domestic firms. And even after today, we're still trading below where the Russell gapped up to on the 6th of November, day after the election. And so for those tailwinds for small caps, that actually also plays into headwinds for mega cap tech, as they're more vulnerable to a global trade war with unique risks coming out of China. Maybe part of the reason tech is pretty much flat year to date. Technology sector not even up 1%, even though pretty much every growth asset around the world is up year to date, led by gold miners, 21%. Brazilian shares up almost 13% year to date and doing well right out the gate. Healthcare, biotech, and financial stocks. Whilst the Russell 2000 still only up 3.82% year to date. Are we going to see a monster year for small caps? Maybe up 20-30% or more? Whilst maybe mega cap tech ends the year flat. And just technically speaking, looking at the Russell versus S&P 500, typically when markets bottom, they rally hard off that bottom. Some of the best moves are really early on as the market flips from bearish to bullish. And one example we saw of that last year, something I was really bullish on coming into 2024, Chinese stocks. From the start of last year up until October, at one point they're up almost 80%, and that's using the large cap Chinese ETF FXI as well. So after markets have been in a bear market for a few years, as markets quite often do, they overreact. The trade becomes too much of a consensus, the whole market gets offside and just sets up for a really vicious bounce off those lows. So I suspect the same thing could happen with small caps versus large caps, as we have seen in the past. When they bounce, they can do so with quite a lot of vigor. And so it's not just the technicals and fundamentals that are looking good to me for positioning in small caps this year, it's also the valuations. Currently the median PE in the S&P 500 is just below 20. You've got to remember the average PE, which is more closer to 25, 26, is due to those mega cap techs, skewing it to the upside. But just looking in the middle of the group, not hard to find a large cap for around 18 times earnings. However, small caps are still around 15 at this point in time, still significantly cheaper than large caps, whilst we've got EPS growth coming back to small caps this year as well. Like I said, on top of regulation and tax incentives that could actually turn out to be a headwinds for some of those mega caps. And just looking back at the 10-year average of the next 12 months PE ratio for groups of stocks, you can see growth really above the trend line over the last 10 years. However, small caps, as we can see in the S&P 400, 600, believe it or not, they're still actually below the last 10-year average. And so for those reasons, I believe small caps continue to offer some great opportunity in 2025. You can still find quality small cap stocks that are growing on a PE less than 15, applying an earnings yield of 7% and growing, which I consider a lot better than the 4.5% by lending your money to the government via treasury bonds. And so you got to remember with the market, stocks will trade not only on their fundamentals, expected fundamentals, but also on the sentiment around the stock. That's kind of what changes its multiple. And we can see that in the technicals and how a stock responds to good news. And maybe why mega cap tech could remain under pressure for some time yet, if not completely underperformed this entire year relative to other groups of stocks, because we can see Microsoft had pretty good earnings last week, good outlook, cloud AI still growing really good, but the stock gapped down and quite hard, over 6%, pretty big move there for Microsoft. We do appear to be finding some support here, and no doubt in the short term we could have a bounce, but this could be range bound for months to come. Kind of similar price action with Apple. Their numbers weren't all that bad, market's reaction to them pretty soft, and again last Monday with NVDA on news of DeepSeek coming out of China, Market whacked it down 17%. And then here we are today. Alphabet actually came out, again, numbers pretty much meeting Wall Street expectations. Some headlines saying investors worried about their increased capex, $75 billion this year. However, if you study history and what performs well in the market over time, it's companies that invest for the long term, invest in R&D. However, those that prioritize short-term financial returns or ignore trends in the market, don't want to invest, they typically get cut down to size. Intel comes to mind of late, probably one of the most famous examples, Blockbuster, not adapting from the secular trend of physical to digital when it comes to people watching movies, of which Netflix came in there and did so themselves. And again, they have one of the most exceptional businesses in the world, streaming content to hundreds of millions of people around the world. Very strong pricing power, not to mention some of the best scalability in the world as well, being a digital platform. We'll also get a look at Amazon's earnings tomorrow, who've been holding up pretty good. However, apart from all those other mega cap techs that have been soft of late and after earnings, the exception is Meta, who not only came in with blowout numbers, but the market is warming up to them a lot more because their core business of advertising, putting ads in all our feeds, is benefiting more from a boost in AI spending versus the still very persistent worries in the market over AI's impact on Google's core business of search, which is definitely somewhat warranted ever since GPT came out. Many people are using chatbots now to access the same information they would have prior done with search. However, I definitely wouldn't rule Alphabet out. They're investing heavily in AI. They'll be up there with the best of them when it comes to personal AI agents. Gemini is still early days, but it's pretty much on par with GPT and Llama, not to mention, in my opinion, their most valuable asset and which could actually be spun off one day, YouTube. I think YouTube will eventually be a bigger business than Google. As video content isn't so easily replaced by AI at this stage, humans will always want to watch other humans, and so I think YouTube's a really powerful platform. But for sure, the here and now, the Meta family of apps, the potential of VR, metaverse, and their forward PE, still only 25, implying earnings yield next year of 4%. Not too bad for a really globally dominant growing business versus Alphabet's 23. So only 2 more points in forward PE for Meta versus Alphabet. And just looking at a long-term monthly spread chart of Meta versus Alphabet, they've pretty much been neck and neck ever since Meta came onto the market back in May 2012. However, we are pushing up against these all-time highs. Remember, the more the market presses against a resistance zone, the weaker it gets, and eventually it can break through. And typically when a market breaks through resistance, it can keep running. Just the same when a market loses support, it can quite often set off a bit of a move before it finds a bottom, and sometimes a V-shaped bottom, like Meta did. One of the biggest recoveries we've ever seen from a mega cap. And so like I said, I wouldn't rule out Alphabet, but Meta could very well continue to outperform them this year. As for the here and now, they're in a little bit better of a position, and Alphabet still has to prove itself that it can defend its huge search revenue. Next up is AMD, and just like I was suggesting in yesterday's video, those levels we saw overnight in post-market session trading, below 110, actually got down to 106.47 there. 6 p.m. last night, I suggested they could be good value areas. We may see a dip buy, and looks like we did straight off the open here today, with what could very well be the start of an accumulation base here on AMD. We have been ticking down for a few months here, and typically bottoms form on big volume, and they did come in line largely with expectations. Stock's the best valuation we've seen in years. In fact, it's trading at similar levels we saw back in October 21, and their business is still growing really fast. In fact, data center revenue was up 94% for the full year to $12.6 billion. That's huge growth. They're still part of this secular AI trend. NVIDIA is no doubt still the clear leader when it comes to GPUs. AMD is doing their best to try and catch up, so they do have that potential. And like I said, technically speaking, looks like some big money came in here and gobbled up this dip this morning. And just looking at a long-term spread chart of AMD versus the semiconductor sector, ETF SMH, this is actually the first time in over a decade the stock has been oversold to this sector. Just looking at my buy-sell bands here. The third month it's traded down into them. The last time we saw that was all the way back in October 2012. And that was actually not a bad time to initiate a position in AMD. Did come down and form a double bottom before the stock then significantly outperformed the sector for almost the next 10 years. And just looking at the weekly chart, I can see my reversal signals indicator firing off here. For those of you who don't know, these green and red arrows you see on the chart, it's my own unique indicator that's designed to show when a move may be exhausted. And like any indicator, it's not right all the time. However, this is one of my most accurate indicators that I've got, and anybody can get access to all of my 28 custom indicators. Just click the link below this video to check them out if you're interested. But like I said, no indicator's right all the time. It did fire off a false positive back in May last year, but just going back before that, it did fire off one there in October 22, which was a sign of the bottom. Prior to that, pretty much nailed the bottom to the tick in April 21 on the spread of AMD versus semiconductors. The stock outperformed significantly for the rest of 21. Going back even even further, we'd have to go all the way back to 2018 for the price signal. Again, nailed the low there of AMD being oversold versus the sector. So technically speaking, stock is deeply oversold. We're probably closer to a bottom than a top, and a pretty strong volume thrust there at the lows. And like I said, this is typically what we see at bottoms. Big volume occurring, accumulation, shorts getting exhausted, covering. And so if anybody bullish on AMD, there's a few ways you can play it. Of course, you can just buy the stock. However, those into options trading, you can get a little more creative. You could look at selling some puts on it. The IV still juicy relative to historical IV. Just looking at the 110 puts expiring later this month and regular OPEX, still trading around 250. That's $250 in credit against every option contract, 100 shares. If you wanted to protect yourself from the upside, you could turn it into a risk reversal, take that credit, put it into the 115 calls. So the spread will pretty much cost you nothing. However, when it comes to buying calls, typically you want to go far out and deep in the money. So you could even look at something like the December expiry and the 100 calls trading around $25 per contract. So that limits your downside to $25 a share. And wherever the stock is trading on the 19th of December, that'll be the intrinsic value of the option. So break even will be 125. And so when it comes to options trading, typically if you're buying options, like I said, you want to buy calls in the money and far out. But when it comes to selling options, the best thing you can do is pretty much the opposite. You want to sell puts out of the money and typically less than 30, 40 days to expiry. But you should only sell a put on a stock that you're happy to own. And of course, your account has to be approved to write options. And generally, the margin for writing that put will be the same for holding 100 shares overnight. So depending on your broker, you got a margin account that may be 2 to 1 or 3 to 1. And with my broker, the margin to write the 110 is $3,000 a contract versus the notional value of $11,000. So again, we'll keep an eye on AMD. I'm not saying for sure it's definitely bottomed here, just saying could represent good value, asymmetric bet, and we may be in the process of starting some accumulation and a bottom, which of course could go on for a few weeks, if not a few months, before it gets back into an uptrend again. But relative to the entire sector, it is definitely oversold. And because just like we heard from Google and their plans to up their capex to $75 billion this year, probably helped NVIDIA rally today, that's also got to be bullish for the entire chip sector. But just keep in mind, like I said, they actually face some headwinds this year that other small cap stocks may not. With the biggest stock in the market potentially coming in the firing line, China reportedly considering a probe into Apple's App Store practices, as they do pretty much operate a monopoly. We also heard the Chinese announce a similar thing with Google. Even though they don't have much exposure in China, these could be warning shots from the CCP. They are willing to bite back and potentially dial up a trade war with the Americans. So this still has the potential to get nasty. And like I said, if it does, mega cap tech could come in the firing line. So in addition to Apple, even though they may bounce around for a little while here, actually setting up some good mean reversion trading opportunities, we may not see the explosive growth that we've come to expect from this group of stocks over the last couple of years until we really clear the way with the US-China tariffs and trade war. And like I said, we can't rule out the possibility of Xi and Trump doing a good deal as well, in which case that could really light up this group again. Once those risks have been dropped, the market can get back to focusing on their dominance and growth and the whole AI bull market. Because at this stage, even though China did respond, it was a very small bite back. Trump started off by slapping 10% tariff on all Chinese goods across the board, equivalent to over $500 billion in exports to the States, where China responded by only putting tariffs on $14 billion worth of goods coming into their country. So by the looks of it, they don't want this to go big. They had to save face by responding, but they did so in a very small way. So that is a good sign, at least at this stage. Not to mention the market for Chinese securities is actually held up throughout Trump's entire first 2 weeks in office. And on this announcement, pretty good result actually. And this is on top of the well-timed release of DeepSeek on Trump's first day in office. Another tactical move by the Chinese as part of this big overall negotiation that may indeed take a few months to play out and may actually have to get worse before it gets better. But just looking at the VIX, for the start of a potential global trade war, 15.78 is pretty good. Market's relatively tame at this stage, on pretty stable footing. Actually pretty steep contango curve in the volatility term structure. Option dealers pricing 6-month options at an annualized rate 19.2. Which is a pretty big gap between 9-day options, priced at an annualized rate of 14.8. And that's the way the market normally trades. There's a premium to buy further dated options, as it's more likely we'll see a spike in volatility at some point in the next 6 months than we will in the next 9 days. So the market doesn't just give that away for free. You got to pay a premium for that. However, when the market goes into backwardation, especially when you see the VIX front month futures contract go above the second month, that's option dealers pricing in immediate volatility right around the corner. And we got that warning signal on the 2nd of August last year, before we had that massive gap down and VIX spike on the 5th. However, right now, like I said, volatility markets are pretty chill. And just looking at the Kansas City Financial Stress Index, looks at a whole bunch of things. Credit liquidity, currently at some of the lowest levels we've seen this entire secular bull market. And again, markets can typically give you some warning signs before things start unraveling, like this index did back in '07, going into the GFC and really shot up there, going into COVID as well. So overall, markets on firm footing. But just like we've been seeing over the last 2 years, option traders are still betting on further rallies in big tech, buying up calls on Apple and Amazon, as those trades have just worked out so well the last couple of years. But like I said, buying short-term options is typically a gamble. There's nothing wrong with buying long-dated calls, and in fact, they're actually systematically undervalued, just like short-term puts are systematically overvalued, offer a risk premium for those that can underwrite them. The thing with options is they actually assume a binary outcome with stocks. 50% chance they'll be up, 50% chance they'll be down. Whereas in history, stock market finishes higher 73% of the time on a yearly basis. Same deal for a good stock. Not to mention many investors write covered calls. That suppresses implied volatilities on call options. And so even though we like to hate on the Pelosi's a lot, they actually know how to do it. And that's why they buy long-dated, deep in the money calls on good quality stocks that they obviously understand very well. But of course, all these zero DTE, weekly options earnings that people are buying, and you see on Wall Street Bets, I mean, yeah, it's fun, it's entertainment, but it's pretty much just gambling. A lot of people don't realize they're in the market just for entertainment and gambling. They think they're in it to make money. They think the people they follow are trying to help them make money, but it's really just entertainment and gambling. On the other hand, puts are systematically overvalued because a lot of investors and funds buy them as insurance. And so like I said, when it comes to options trading, the edge in buying them is in long dated in the money calls. The edge in selling them is the opposite, selling short dated out of the money puts. And just speaking of gambling, sports betting is actually exploding in the States as more and more states legalize it. Americans set to bet a record $1.39 billion on Super Bowl this weekend. And for the first time, a state other than Nevada will see the most money wagered, with New York and New Jersey potentially looking to overtake Sin City and the amount of bets they take in. And there's a look at the growth of legal Super Bowl bets in billions. Coming out of COVID, just 300 million. Here we are 5 years later, it's 5x, $1.5 billion. This is another secular trend. Now got 38 states allowing some form of sports betting, covering roughly 70% of the American adult population. And so potentially this year, we could see a new record, maybe over 68 million Americans bet on the Super Bowl between the Philadelphia Eagles and Kansas City Chiefs this Sunday night. And just looking at relevant stocks in the market, DraftKings have a popular online sports betting app. Just going out to a monthly chart here to see how long they've been on the market. Okay, so they were around in Super Bowl 2020. If we just go back to the daily chart and I change my seasonality forecast to look back the last 5 years, if we go back 6, yeah, they don't have data for the 6th year. So first Super Bowl, DraftKings over the last 5 years, 2 days left in this week, first 3 trading days of next week, then earnings later next week, typically around this time. When Super Bowl's always held around this time, DraftKings can do pretty well, up over 8% over the next 5 trading days, this same period looking back the last 5 years. Not doing as well though, Caesars. They run a big sports book. They don't have the same bullish seasonality, nor does MGM. However, over the next 5 days, Flutter Entertainment does. They're a big global betting company. They got Sky Gaming, Paddy Power, Betfair, and FanDuel. And the sports betting stock I have as part of my stock picks portfolio, Genius Sports, much more volatile small cap, and they actually power a lot of the technology behind sports betting around the world. A lot of different sports with really strong market share and positioning. Another stock we've been in since last year that's been performing well for us. And just speaking of hot stocks, still plenty out there. Look at Oklo, the nuclear trade, still ripping. Former market darling of yesteryear, BlackBerry. Look at that run. Stock I gave you guys last week, so to keep a close eye on as we could see a big move in it. Record Systems, breaking out today up almost 20%. The other one I said to keep an eye on, Grail, cancer detection. Small cap biotech is really hot at the moment, especially if it's got anything to do with AI. Tempest AI, up big again today. And another one, Rapid Micro Biosystems, life sciences company actually involved in vaccines. Not to mention the other hot ticker we've been watching as well, Ginkgo Bioworks, DNA. Big solid move again here today on volume, 14.5%. RFK getting confirmed as Secretary of Health. He's big into psychedelics, natural medicines, mind medicine, MNMD. Another one we've been watching. Really strong move here today on big volume. And my long-term favorite, one of the most controversial stocks out there, Moderna. Super volatile, but I have high confidence this is going to be a great stock in the long term. It's just one of those names that's always going to get thrown around. Got earnings coming in a week and a half, and I'm not in it because of COVID. They've actually got over 40 drugs in their pipeline, a unique mRNA platform, develop drugs a lot quickly with higher efficacy than others. And my bull thesis rests on a long-term secular trend of personalized cancer vaccines, which I think they could absolutely dominate, and I think the world actually needs this stock. But I also agree with RFK, who is not anti-vaccine. He is pro-testing, pro-safety, and pro-choice, all of which I agree with. I just think this is one of the ultimate long-term asymmetric bets in the market. I'm a long-term holder, and I've actually been selling more puts of late as well. And that's because the puts on them are just so juicy. Implied volatilities are 77%. And like I said, the opportunity is huge in my opinion. Market cap only 13.4 billion. I think it could be multiples of that at some point over the next 10 years or so. Of course, this is all just my opinion I'm sharing with you. Please do your own research. Trading and investing in stocks, including options, does come with risks, so please understand what you're doing before you trade, along with having realistic expectations, as these are not really grandma's bonds. They're going to move around a little. Similar thoughts on Uber, which I'm another long-term holder and had been buying the dip last year as well on. They just came out with earnings. Just like Alphabet, the market's worried about how the secular trend and robo-taxis is going to affect them. Tesla could eat their lunch. I own both because I think we could see a world where they both succeed. In fact, Uber may actually buy Tesla Cybercabs to run on their already globally dominant platform. I consider them the number one transport stock in the world. Everywhere I go in the world, I use Uber to get around and get food delivered to me. Hotels, they're always the dominant service everywhere I go. The valuation's great in my opinion. They're only trading at 20 times free cash flow while still delivering very impressive growth. Gross bookings up 21% year over year. 3-year outlook, mid to high teen and compounded annual growth. And look at that, an adjusted EBITDA, 60% and free cash flow. Market was worried for a few years on their cash flow, so they've addressed that really well, but the stock's still somewhat languished, definitely behind the market since 2019. I think it's got a lot of catching up to do. Market cap 135 billion. There's another stock I expect could potentially hit $1 trillion within a decade, offering up a 10x gain. But I haven't written any puts on them. IV is not as juicy in the mid-30s. I just own the common outright. And so ever since Russia invaded Ukraine, US bit back with big global sanctions, prompted foreign banks around the world in their pursuit of de-dollarization. Another thing Trump's fighting back against. And part of that push has been buying record amounts of gold, which it doesn't look like they're slowing down. Getting plenty of signs the Chinese and the Russians still buying huge amounts of it, withdrawing from some vaults as well. And we can see that technically in the price of gold. Persistent buying did have a little bit of a 10% pullback there in October last year, but hasn't done too much bigger than that over the last couple of years. Very persistent bull market here in gold. One of the leading commodities now, and just looking at the entire commodity price index, 10-year rolling compounded annual growth rate just gone back into positive territory. Really good. Commodity market has big, long, bear and bull markets. Underperform, outperform, and so you can see these persistent waves. And so we could potentially not even be halfway up through this current wave. And that's the commodity complex as a whole. But looking inside it at gold miners, not only their valuations, the cheapest relative to the underlying, relative to the price of oil and their profitability, but also global investors' allocations to gold miners. Very low, just looking at this chart here, ETF market share of gold miners versus equity ETFs. It's not even 0.5%. So when money comes back into this sector, it could really light up the market for gold mining stocks. And that could go on for years and years. Like I said, commodity cycles are very long. And we saw that again today with gold miners. Like I hinted earlier this week, could provide a good hedge on global trade war, in addition to just working out regardless of the worst case outcome. Hence why I'd taken a bullish position at Newmont, writing the 42 puts. Looks like I'm going to have to write some more puts as it rallied up pretty hard today, 3.7%. So I'm happy to collect premium until I inevitably get the stock put into my account, but I won't chase it too much more. May just write the 43 puts expiring in March, but would ideally do so on a red candle. And one of my gold stocks that I own, Alamos, having a great day, multi-year breakout. This is a really good market. We've got high growth, small cap, and commodity performing at the same time. A lot of dispersion. Like I said, it's a bit of a stock picker's dream market, and that's no doubt why the brokers are performing really well. Look at all this volume coming into interactive brokers, just thrusting to the upside here. Not to mention Robinhood, really strong, persistent uptrend. Otherwise, that's a wrap for today, guys. We also got US services PMI coming a bit softer than expected, still expanding at 52, but enough to get bond yields pulling back, especially on the 10-year. Lost a little bit of support there, 442. That's good for stocks, as they were getting a bit worried about these yields running away, helping to keep a little bit of downside pressure on the dollar. We also got jobs this Friday. Unemployment rate expected to come in 4.1%. We'll see what happens there. Otherwise, we got Amazon earnings tomorrow night. See whether the market gaps them down as well, even if they come in with good numbers. But like I said, Russell 2000 small caps are looking good to me, and we could be on the cusp of breaking out to some fresh monthly highs. And then we're within the stone's throw of another new all-time high. Thanks for sticking with Click Capital, and I look forward to breaking it all down for you again this time tomorrow. Cheers.